Hello investors, welcome back to the channel. As a quick background, I'm a former finance professional. In this channel, we discuss topics like stocks, markets, options, investing, financial analysis, real estate, and personal finance. Please press the subscribe button below if you're interested in any of these topics. In this video, I'm going to talk about how to pick the right options. I've seen many videos that talk about options like making monthly income through selling options. While these are great points, I wanted to start from a more fundamental standpoint and understand options from a broader level. I'm also going to keep definitions of calls and put options for simplicity purposes, and I think the basics of options can be learned better through reading pages like Investopedia. Options are mainly used by professionals to hedge their positions. For example, if you have positions in Disney and you think Disney's stock will plummet in the near term, you want to protect your stocks by buying put options. There's also a very popular strategy often used by Warren Buffett as well, where you sell covered puts so that you buy expensive stocks at cheaper levels. I'll be covering these in future videos as well, so make sure to press the subscribe button below if you'd like to see those. In this video, I'll be covering which call options to buy when you're confident in the stock's price movement. For example, if you want to buy a call option on the stock because you think the stock will outperform in the short term, which strike price should you buy and what expiration date? To answer these questions, you need to find out what the risk-reward ratios are. For instance, in a coin flip, let's say you gain $100 on heads and you lose $100 on tails. It's a 50-50 game and your expected return is $0. Another coin flip gives you $200 on heads and you lose $100 on tails. The expected return is $50 on this game. So you definitely want to play this game because your risk reward is in your favor, meaning your gains are larger than your losses for the same chances of each scenario happening. This is what's called having a positive convexity risk reward. It's exactly the same concept in not just options, but also in anything actually. Look at the below risk reward profile for PDD call option. This is a graph of total return profile for PDD call option in different scenarios. This assumes that you bought the option today and held it until November 30, 2021 for about 2.5 months. On November 30th, you would have about 52 days left until expiration. And say if a stock price goes down 30%, you lose 100% of your premium. And if the stock price goes up 30%, you gain 146% on your premium. You apply the exact same concept with the coin flip here. Your stock goes down 30% and you lose 100%. Your stock goes up 30%, but you gain 146%. And this is a very positive convexity risk-reward profile. However, the major difference is that if the stock price doesn't move at all, you lose 75% of your money due to theta decay, which will be covered in future videos. This is a very important point, and you should follow this strategy only if you expect a large price movements in the underlying stock. Now back to the discussion. What we're trying to determine is what exercise price and what expiration date we should buy. I currently hold this call option in PDD. This one expires in 4 months with $130 strike price and the stock closed at $104. I have this position and my potential exit date is 2.5 months from now, on November 30, 2021. At the expiration date, I'll only have 1.5 months left. That is not an ideal situation because ideally, I want to have at least 2 months left until expiration. This is because the value of money that you lose each day due to theta decay on options gets exponentially higher within the 2 months of expiration. Next, my holding period, as discussed before, will be about 2.5 months from now. Stock price is currently at $104 and the option premium is $5.3 or $530 because each option consists of 100 stocks. So you multiply your option premium by 100. Below table is a total return profile. When the stock price is unchanged by November 30, your total loss is 75%, meaning you lose 75% of your option premium. This loss is due to theta decay, meaning you lose the time value of option, so it's very important that you expect some type of volatility when purchasing options. Delta is percentage change in the premium of the option per 1% change in the underlying stock price. Basically, the higher the delta, the higher the option premium movement per 1% movement in the stock price. Theta is how much you lose per day on the premium due to time decay. Every day, your option premium goes down because that time value of option loses value due to shorter time to expiration. Finally, the return on investment is what you want to pay attention to. If the stock goes down by 30%, you'll most likely lose 100% of your option premium, which makes sense. If the stock goes up 30%, you gain close to 150% or more than double your money. As mentioned before, you want this upside to be highest as possible, with as low theta decay as possible. I have capital gains on this call right now, and I'm trying to determine whether to sell this or not. I'm still very confident in the stock's performance, but I think there may be some turbulence in the short term, so I want to decrease my risk exposure. So I have two main goals: one, to extend the time horizon, and two, to reduce risk. One way to accomplish these goals is to find which options to roll into. Let's compare my current call option with another call option that expires in April 2022 with a higher strike price at $150. The total return profiles look pretty close, right? I know the total return on the new position may be lower than the current one, but the great benefit of buying this new call option is that my expiration date is further out. At the end of my assumed holding period until November 30, 2021, I still have 4.5 months left until expiration. Generally speaking, I like to have at least 4 months until expiration when I decide to sell my options. So if I buy a 8-month call option and 4 months goes by, it turns into a 4-month call option. So I decide to either sell it or roll into another call option by extending maturity. So this new call option allows me to achieve 1, similar total returns as my current positions, and 2, extend my time horizon. I'm also only going to reinvest 80% of my proceeds from the original call option to reduce risk. I know there are a lot of moving pieces in options, but the main idea I wanted to get across is assessing the risk reward for any investment that you're making, whether it be options, stocks, MBA degree, or buying a house. When you're buying options, buy the ones that will have the greatest convexity, meaning the biggest gains for percent price change upwards compared to a percent price change downwards. And this can usually be done via purchasing far out of the money call options or put options. Everyone's goal should be to get more bang for their buck, in my opinion. This part is an appendix and I'll explain what options are and how they work. Call option is a right to buy a stock and put option is a right to sell a stock. Think of these as stocks, except these are not ownerships in the companies but contracts. You can still buy and sell these contracts like you trade stocks. And the idea is you want the prices of these contracts to go up, just like you buy a stock hoping the price will go up. In an option though, you have what's called the strike price. This is the price at which you can buy the stock. For example, a call option with a strike price of $100 expiring in 5 months means you have the right to buy the stock at $100, but that right ends in 5 months. If the stock is trading at $150, then you can buy the stock for $50 cheaper than the market price at $100, because that's the right of the option. That sounds pretty good, right? The catch is that your option contract will already be priced to $50. So even if you buy this option for $50 and exercise it to buy the stock at $100, you still spent $150 in total to buy the stock that's trading at $150 market price, breaking even on your option purchase. I'll be covering more on the basics of options, so please press the subscribe button below if you'd like to see those. Thanks all for watching.